$5.15 billion. That's that's the number sitting right in the middle of the table today. It is Monday, January 26, 2026.
It's a huge number.
It is. And if you thought bank earnings season was going to be, a little boring, Capital One just dropped a bomb.
They really did. And honestly, it's not at all what the market was expecting to find when they, cracked open the Q4 earnings deck this week.
Not at all. Usually we come into these deep dives on bank earnings expecting the standard menu. Net interest margins, maybe little on loan growth.
Some polite commentary on the consumer.
Exactly. But Capital One, on the 22nd, they aren't just reporting their report card. They are acquiring Brex.
And that just completely changes the conversation. We aren't just looking at a bank's quarterly performance anymore. We're really looking at a fundamental shift in their strategy.
It feels that way.
Richard Fairbank, the CEO, has been using this phrase for years. He says they want to win where the world is going, this acquisition. This is basically the proof of concept for that philosophy.
So we have a massive agenda today. I think we have 3 big mountains to climb in this deep dive. First, we have to unpack this Brex deal, because $5 billion is a lot of money for a fintech that, let's be honest, a lot of people just know as that corporate card startup with the billboards.
It's significantly more than that, but yes, I agree. That is the public perception.
Okay, and then we have to look at the actual Q4 numbers, because while the revenue was great a beat, in fact, they technically missed on earnings.
Right.
And there's a very specific story there about credit reserves we need to untangle. And finally, we have to check in on that massive Discover integration and a pretty heated fight brewing in Washington over interest rate caps.
Oh, yeah, that regulatory piece is actually critical. Fairbank came out swinging on that topic in a way you rarely see from a bank CEO.
He really did. But let's start with the headline, Brex. Capital One is acquiring them for $5.15 billion. It's half cash, half stock.
So I think the big question for a lot of people, and probably for you listening, is just why?
Capital One is already a giant in the small business card space. I see their Spark card ads everywhere. Why write a $5 billion check for something you seemingly already do?
That is the intuitive question, but it misses a crucial technical distinction. And Fairbanks spent a lot of time on the earnings call clarifying this. It really comes down to the difference between personal liability and corporate liability.
Okay, let's unpack that. Because to the average person, a business credit card is a business credit card. What is the real difference?
So think about those Spark cards, the ones you see advertised to, the local bakery owner or the freelance graphic designer.
Right.
Those are almost exclusively personal liability products, which means the business owner, the actual person, guarantees the debt. If the bakery goes under, the bank comes after the baker's personal house or personal savings to settle up.
Which makes sense for a mom and pop shop. The business and the owner are kind of the same financial entity.
Exactly. But that model hits a hard ceiling. When you start talking about mid-market companies or tech scale-ups companies with 500 employees or 5,000 private, you can't ask the CFO to personally guarantee the company's travel expenses.
Oh, no way.
It just doesn't happen.
Yeah.
They need corporate liability. The company owes the money, not a specific person.
And Capital One just didn't have that.
They had a tiny foothold, but they weren't real players. They were kind of fighting with one hand tied behind their back in that sector. Brex, on the other hand, was built from the ground up for that corporate liability space.
Okay.
They dominate the startup and mid-market tech sector. We're talking about clients like Anthropic, Robinhood, TikTok, Coinbase, DoorDash.
Wow, those are huge names.
They are. So by buying Brex, Capital One isn't just buying a card portfolio. They're buying a ticket to move way up market.
So instead of just serving the bakery on the corner, they can now serve the venture-backed unicorn that might become the next Google.
Precisely. Yeah. And it's not just about the plastic card. This is the other piece of the puzzle that really justifies the price tag. Brex isn't really a card company. They're a software company. They built what they call a financial operating system.
Okay, buzzword alert. Financial operating system. What does that actually mean for the user?
It means the end of the receipt shuffling nightmare. I mean, if you've ever worked in a corporate environment, you know the pain. Saving receipts, taping them to paper, scanning them in.
Ugh, the expense reports, yes.
Brex integrates the banking, the credit card, and the expense management software into one stack. Fairbank was practically gushing about their tech on the call. He pointed out that Brex is AI native.
AI native in what way? Is that just a chatbot?
No, it's deeper than that. They are using AI agents right now to handle expense audits and receipt matching. The software understands what the expense is, categorizes it automatically. It's a huge efficiency play for businesses.
That is a huge leap from the legacy banking tech we're all used to. Usually when a big bank buys a fintech, the integration is a total nightmare.
It's always the risk.
The bank's systems are running on code from the 1980s.
And that is the risk here. Integration is where these deals often die. But the strategic logic is this best of both worlds argument. Banks have what fintechs desperately need: cheap capital.
Right, the deposits.
Capital One has massive federally insured deposits. They can fund the lending incredibly cheaply. Brex has the shiny software and the user experience, but their cost of capital was high because, well, they aren't a bank.
So Capital One provides the fuel, the money, and Brex provides the engine, the tech.
That's the perfect analogy. Fairbank actually called it the tip of the spear for their commercial business. They want to use Brex to pierce that market of heavy-spending corporate clients.
Now, whenever I see a big strategic acquisition, I immediately look at the shareholder reaction. Did they hate the price? Because $5.15 billion isn't pocket change, even for Capital One.
No, it's about 3.5% of their market cap, so it's significant. The reaction was measured, I'd say, largely because management was very transparent. They admitted that this is going to be dilutive to earnings in the short term.
Dilutive, meaning it lowers their earnings per share.
Right, because they're issuing new stock to pay for half of it, and they have integration costs to absorb. So the slice of the pie for existing shareholders gets a little smaller, or the pie itself shrinks a bit, temporarily.
But they expect it to add value later on?
They do.
Huh?
Accretive is the word they used. But I noticed they threw a bone to investors regarding buybacks. That seemed very calculated.
A very large bone, yeah. They made it clear this deal doesn't stop their share repurchase program. They bought back $2.5 billion of their own stock just in Q4.
Exactly. By saying, we can buy Brex and still buy back our own stock, they are signaling massive confidence in their cash flow.
It's a flex. It's saying, we can chew gum and buy unicorns at the same time.
Uh-huh.
Oh?
Essentially, yes. It tells the market that they aren't stretching themselves too thin financially to make this happen.
Okay, let's pivot to the report card itself. Q4 2025. This is a weird one because if you just read the headlines, you see revenue beat and earnings miss. Those two things don't always go together.
Usually not, no.
Usually, if you make more money than expected, you keep more money than expected.
Usually, yes. But banking accounting has its quirks. The top line was fantastic. Revenue came in at $15.62 billion. That beat expectations by over $130 million. Year over year, they were up 53%.
53% growth for a bank it's just unheard of. But we have to put a massive asterisk there.
A massive asterisk.
Yeah.
That growth is largely because they acquired Discover. So you're comparing a post-merger Capital One to a pre-merger one. It's apples and oranges.
Okay.
But even if you strip that out and look at the organic business, the revenue engine is humming, people are spending, loan balances are up.
So the money is coming in. Where did it go? Why the earnings miss? They reported $3.86 per share, and the street was looking for $4.14. That's a pretty big gap.
The culprit, if you want to call that, was the provision for credit losses, or PCL.
Which always sounds so ominous, like they just lost the money.
It sounds terrible, but it's actually a prudent accounting mechanic. The provision was $4.1 billion for the quarter, and that is up $1.4 billion from the previous quarter.
Wait, a $1.4 billion jump in just 3 months? Does that mean borrowers suddenly stopped paying their bills in October? Did the economy tank and we missed it?
No, and this is the nuance that really matters. The provision is a bucket they fill up to cover future potential losses.
Okay.
In the previous quarter, Q3, they actually took money out of that bucket, a reserve release. In Q4, they put money into the bucket, an allowance build of about $302 million.
So the swing from taking money out to putting money in creates this huge expense on paper.
Exactly. It swings the math by over $1 billion. Plus, you have seasonality. Q4 always sees higher charge-offs. People spend more during the holidays, maybe miss a payment.
Right.
But if you look at the underlying credit metrics, delinquencies, charge-off rates, they're actually stabilizing. This wasn't a panic move. It was a return to normal seasonality move, combined with just building a safety net.
So they're just saving for a rainy day, essentially.
Correct. And accounting rules require them to book that saving as an expense immediately. It hits the bottom line today to protect the bank tomorrow.
Speaking of expenses, it wasn't just the credit reserves. They are spending a fortune on marketing. I saw $1.9 billion in marketing spend. That seems incredibly high.
It's up 41% year over year. They are absolutely flooding the zone.
What are they buying with that money? Just more what's in your wallet commercials with celebrities.
It's more targeted than that. They are fighting a two-front war. On one side, they are pushing the heavy spender franchise, the Venture X cards. They're trying to steal those premium customers from Amex and Chase.
Right.
And on the other side, they are pushing the national bank brand. They want your checking account, not just your credit card.
That's a key shift. Capital One used to be just the card in your wallet. Now they want to be the app where your paycheck lands.
And winning that primary banking relationship is expensive. You have to offer cash bonuses, you have to advertise everywhere. But once you get that direct deposit, that customer is incredibly sticky and profitable.
So it's a bet.
It's a bet that spending $2 billion now secures those relationships for the next decade.
It feels like they are trying to be everything to everyone. Premium travel, national banking, now with Brex, corporate finance. Which brings us to the other massive piece of the puzzle, Discover. It's been about a year since they announced that deal. How is the digestion going? Because swallowing a network like Discover is not a small meal.
Digestion is a good word for it. It's slow, but it's moving. The update on the call was that the debit card migration is nearly done. So if you have a Capital One debit card, it's probably running on the Discover rails now, even if you don't realize it.
And the credit cards? When does my Venture card switch to the Discover network?
That's the longer road. They don't expect to start originating, so creating new credit cards on the Discover network until mid-2026.
Oh, wow.
But there was a term Fairbank used regarding the Discover loan portfolio that really caught my ear. He called it a brownout.
A brownout, like when the power grid dips in the summer?
Exactly. He was describing a deliberate slowdown in loan growth on the Discover side of the house.
Why would they buy a credit card company and then slow down the lending? That seems completely counterintuitive.
Because they're cleaning house. Discover had already pulled back on marketing before the deal closed. Now, Capital One is in there applying their own risk filters. They are trimming around the edges, specifically targeting what they call high balance revolvers.
Define that, folks.
These are customers who carry large debt balances month to month. Historically, Discover was okay with that risk profile. They liked the interest income. Capital One is much more conservative. They prefer transactors, people who spend a lot but pay it off. So they are actively letting those high-risk Discover customers roll off the books, hence a brownout in growth.
They're shrinking it to fix it.
Right.
Yeah.
But we have to remember the loan portfolio wasn't the main prize in the Discover deal. The prize was the network.
The rails.
Yes. Fairbank reiterated that.
Yeah.
The long-term play is building the Discover network into a true global competitor to Visa and MasterCard. That's a 10-year project, not a quarterly one.
So we have the Brex integration, the Discover integration. It's a lot of moving parts. But all of this operates within the actual economy. It's 2026. How does Capital One see the consumer holding up?
The word of the day was resilient. We've heard that for a few years now, but it still seems to hold true. You know, inflation is sticky, interest rates are high, but people have jobs and they're paying their bills. But there was a fascinating little nugget about tax refunds that I love.
I saw this, the one-time good guy.
Yes. So apparently, because of some retroactive tax cuts passed last year, tax refunds in early 2026, so right now, are going to be significantly higher than normal.
It's a nice surprise stimulus check.
It is. And Capital One explicitly mentioned this as a tailwind for Q1 and Q2. They expect delinquency rates to actually drop because people are going to take those fat refund checks and pay down their credit card balances.
But they were careful to say one time.
Oh, yeah. Don't get used to it. Withholding tables will adjust, and next year we'll be back to normal. But for the next 6 months, the consumer might look artificially healthy because of this tax quirk.
Okay, we can't wrap up without talking about the elephant in the room, the regulatory environment. This proposal floating around for a 10% cap on credit card interest rates.
This is the topic that gets bankers sweating. And Fairbank did not mince words. Usually, CEOs are very diplomatic, we look forward to working with regulators. Not this time.
He came out swinging.
He did. He laid out a very stark argument against the 10% cap. His logic is all based on risk-based pricing. Essentially, if you cap the interest rate at 10%, the math of lending just breaks for a huge portion of the population.
Explain that math. Why can't they just charge 10%? That still seems like plenty of interest.
Because lending money costs money. There's the cost of funds, the cost of operations, and most importantly, the cost of risk, the chance the person won't pay you back. If you can only charge 10%, you can't cover the risk of lending to someone with a 650 credit score.
So his argument is that if the cap passes, banks won't lower rates. They'll just stop lending.
Exactly. He argued it would eliminate access to credit for subprime and even near-prime borrowers. You'd basically only have credit cards for the wealthy. And he took it a step further. He warned that since consumer spending drives 70% of U.S. GDP, if you cut off credit access, you kill spending. And if you kill spending,
You get a recession.
a nasty one. It was a very high-stakes warning. Pass this rule and you crash the economy.
Yeah.
He also touched on the Credit Card Competition Act, but the 10% cap was clearly the existential threat they're focused on.
It's a paradox, isn't it? The regulation is meant to help people struggling with debt, but the industry argument is that it would just cut those people out of the system entirely.
That is the central tension. Capital One has always prided itself on being a mass-market lender. They lend to people building credit, not just the super rich. A 10% cap would fundamentally break their business model.
It's definitely a space we need to watch. So let's try to pull all these threads together. We have a quarter that looks messy on the surface, earnings miss, high expenses, brownouts. But under the hood, they're buying Brex, integrating Discover.
If you look at this through a 90-day lens, yeah, it looks expensive and messy. But if you look at it through Fairbank's lens, it's about positioning. He is willing to take the short-term hits, the earnings dilution, the marketing spend, because he is trying to transform the company.
It feels like they're trying to graduate from being a bank to being a platform.
That's the key insight. Look at the pieces on the board now. They own the network rails with Discover. They own the deposits with the National Bank. They own the consumer spend with the venture cards. And now, with Brex, they own the corporate operating system.
There isn't really another financial institution in America that has that specific combination of assets, is there?
No. Chase doesn't own a network like Discover. Amex doesn't have the retail bank footprint. Capital One is building something unique.
It really begs the question, are they trying to build the first true super app for American business?
It certainly looks like that's the blueprint. The challenge, of course, is execution. Integrating Brex's cloud-native, AI-driven tech stack with a massive regulated bank is not going to be easy.
Oh, I'm sure.
We've seen plenty of tech acquisitions die inside big banks because the cultures clashed or the tech just didn't mesh.
So the potential is massive, but the execution risk is just as high.
High risk, high reward. But if Brex really is the tip of the spear they say it is, Capital One just got a lot sharper.
Well, it is certainly not going to be a boring year for them. We'll be watching the integration and those tax refunds closely.
Absolutely.
That's it for today's deep dive on Capital One, a fascinating look at a company trying to bridge the gap between Wall Street and Silicon Valley. Thank you for guiding us through the numbers.
Happy to do it.
And to our listeners, thanks for tuning in. And hey, speaking of 2026 taxes, maybe go check your withholdings. You don't want to be banking on that big refund check again next year.
Always good advice.
We'll catch you on the next one.